looking to purchase your first home? Well, if you do the following before the end of the year, you can end up saving thousands in tax. There's a thing called the First Home Super Saver Scheme. What it is a federal government incentive that allows first home buyers to make additional contributions to their superannuation fund, claim a deduction for these contributions, and then withdraw this money from their super fund to help pay for their first home. I personally did this when I purchased my first home, and I ended up saving over $10,000 in tax. But wait, it gets even better, because if you do this with your spouse, you can actually double the amount that you get back. This is how it works. Step 1, you make a voluntary contribution to your super fund in one of 3 ways. A, you can salary sacrifice. In other words, you tell your employer to pay you less of a wage and put more into super. What this does is it reduces your taxable income from your wages. Or B, member concessional. This is where you contribute directly to your super fund. Then you lodge what's called a notice of intent to claim form. You get a response from your super fund, and then you claim a deduction in your tax return. And C, there's member non-concessional. This is where you also contribute directly to your super fund, but with after-tax dollars. Although you can't claim a tax deduction, this type of contribution does have its place. On a side note, your usual super guarantee contributions by your employer do not count. Step 2 requires you to maximize this strategy by ensuring that you contribute to your caps every financial year. Both you and your spouse can contribute an additional $15,000 in voluntary contributions each year, and a total of $50,000 per individual can be utilized towards the First Home Super Saver Scheme. Therefore, this strategy works best if you cap out your contributions over a 3 to 4 year window. For example, year 1, you contribute $15,000, year 2, another 15, year 3, another 15, and then finally in year 4, you'll do a final 5 to bring you up to the 50K. Therefore, it's important that you contribute now before the end of the year, or else you might miss out on $30,000 in contributions between you and your spouse. As this strategy might take 4 years, it's best that you plan ahead. Okay, you've now made your contributions, you've gone to the cap, and step 3 is you buy your home. In preparation for this, you will need to lodge a determination with the ATO and request a release of your previously contributed funds. And the final step, number 4, is that you have to declare any released amounts in your income tax return for that financial year. Where this strategy is really amazing is that for these released contributions, you will receive a 30% tax offset. The following example illustrates the real life tax benefit of this. Assume a husband and wife both in the tax bracket of 32%. Over 3 to 4 years, they both contribute $50,000, therefore $100,000 in total has gone into super. Their tax saving equates to 32% of $100,000, therefore $32,000. When they contribute into super, they will be taxed on these contributions at 15%, therefore this equates to $15,000. After they purchase their first home, they will be able to withdraw the $100,000 that they contributed, and then they will pay the difference between their marginal rate of 32% and the tax offset received of 30%. Therefore, they will be out of pocket an additional $2,000. Therefore, their net tax savings equates to the following. First, the $32,000 in tax savings they received initially, less the $15,000 that they paid in super, less the $2,000 top up that they ended up paying when they withdrew the contributions. So their total tax saving equates to $15,000. And on top of this, over the 3 to 4 year period, their contributions would have been sitting in super, earning additional income. This is literally free money. However, you must plan ahead. Note that there are other considerations, including the contribution caps, as well as personal circumstances. Additionally, you have to be committed to purchasing a home, because if you aren't, then your money will be trapped in your super fund. Let me know in the comments if you were aware of this, like this video, and follow me for more tax tips.